Investing is a bit like riding a roller coaster. You're never really sure when the next big drop or rise will come. Even the most experienced investors can find themselves caught off guard by the twists and turns of the financial markets. By understanding these 7 truths about investing, you'll be better equipped to navigate the complexities of the financial world, making informed decisions that can help grow your wealth over time. Hello and welcome back to the Dividend Experiment, the channel that helps you build a portfolio that pays your bills. The content that we discussed is intended for information and educational purposes only, and should not be considered investment advice or investment recommendation. In this video, we're going to talk about some important but overlooked aspects of investing that can make or break your portfolio. From the power of starting early to the impact of your emotions on your decisions, these insights will help you to understand the market and possibly succeed in the market too. Starting early is more powerful than you think. Starting to invest early is one of the most powerful financial decisions you can make, and it's often more impactful than people realize. This is mainly due to something called compound interest. In simple terms, compound interest means that not only does your initial investment grow over time, but the growth itself also starts generating more growth. Example, the difference between starting early and late. Let's look at an example involving 2 people, Emily and James. Emily starts investing at age 25, putting £500 into an investment account every month for 10 years, and then stops contributing. James, on the other hand, waits until he's 35 to start, but then he invests £500 every month until he's 65. Both of them earn an average annual return of 7%. Now let's see how much money they end up with by the time they're both 65. Emily's investment. Over 10 years, Emily invests a total of £60,000. And even though she stops adding money after age 35, by the time she reaches 65, her investment has grown to approximately £481,000 thanks to compound interest. James's investment. James invests for 30 years, contributing a total of £180,000, and by age 65, his investment has grown to about £566,000. So even though James invested 3 times as much as Emily, £180,000 versus £60,000, Emily's early start gave her money more time to grow. As a result, Emily's investment ends up being nearly as large as James's, despite her having invested for a much shorter period. This example shows that starting to invest early can be incredibly powerful. The sooner you start, the more time compound interest has to work its magic, turning even modest contributions into significant sums over time. If you're looking to start your journey in investing, let me introduce you to Trading212, the sponsor of today's video. I asked Trading212 if they could give me a unique code that you guys can simply type into the promo code section, capital at risk. So if you've opened a new account recently or planning to open an account, here it is, DivXP or DIVEXP, short for the Dividend Experiment. So you have 10 days from opening your account to type this in and receive shares worth up to £100. I also get something as this is my custom code, so this helps you support the channel too. If you do use it, thank you for your support, and thanks to Trading212 for sponsoring this video. Feeling financially ready is rare. A lot of people put off investing because they don't feel ready. The truth is, most people never feel completely prepared, and waiting for the perfect time can mean missing out on good opportunities. Financial readiness often seems like a distant goal, and if you wait for everything to be just right, you might never get started. There isn't a perfect time to start investing. If you keep waiting until you feel totally ready, you might never actually begin. The conditions that make you feel secure are always changing, and by the time you feel prepared, you could miss out on valuable chances. So start small, invest in an amount you're comfortable with at first, and then gradually increase it as you become more confident and stable. Investing doesn't need to wait for the perfect moment. Taking small steps can help you learn and grow without feeling overwhelmed. Market uncertainty is inevitable. The stock market is unpredictable, and unexpected events can cause sudden fluctuations. These changes are a natural part of investing, so it's important to understand that some level of uncertainty is always present. The market can move in unexpected ways, and these ups and downs are simply part of the investing experience. To understand this better, look at historical events like the 2008 financial crisis or the COVID-19 pandemic. Both of these events had huge effects on the markets, but they were largely unforeseen. They show that even financial disruptions can happen without warning and impact the market in ways that are hard to predict. The best approach is to embrace the uncertainty, accept that market fluctuations are normal, and keep a long-term perspective. By focusing on your long-term goals and staying calm during the ups and downs, you will be better prepared to handle the inevitable changes that come with investing. No strategy is universally successful. There's no single investment strategy that works for everyone, Different approaches to investing are suited to different people based on their personal goals, risk tolerance, and the current market conditions. What works well for one investor might not be as effective for another, so it's important to find a strategy that fits your individual situation. Consider the variety of investment strategies out there. For instance, some investors look for value stocks, which are companies that seem undervalued compared to their actual worth, and others might prefer growth stocks, investing in companies that are expected to grow quickly in the future. Each of these strategies has its own set of advantages and challenges. The key is to choose a strategy that aligns with your personal goals and be ready to adjust if it's needed. Flexibility is crucial in investing because the market can change and what works well today might need tweaking tomorrow. By staying adaptable, you can better manage your investments and respond to changing conditions. Down markets aren't disasters. Market downturns can be unsettling, but they're a normal part of the investment cycle. Rather than being a sign of disaster, these periods often offer opportunities to buy stocks at lower prices, potentially setting the stage for future gains. While it may be uncomfortable to see your investments drop in value, it's important to remember that these fluctuations are just part of the market's natural ebb and flow. Take Warren Buffett as an example. He's known for being one of the most successful investors in history, and he often takes advantage of market downturns by buying more stocks. Buffett understands that lower prices during downturns can lead to higher gains when the market eventually recovers. His strategy highlights that downturns can be a chance to invest wisely rather than a cause for panic. When the market's down, it's crucial to stay calm and not let fear drive your decisions. Instead of panicking, consider the potential for future gains and maintain a long-term perspective. By focusing on your long-term goals and understanding that downturns are temporary, you can navigate these periods more effectively and position yourself for future success. Rising markets don't indicate expertise. When the market's booming, it's easy to feel like an investing genius. During a bull market, when prices are generally rising, nearly every investment seems to perform well, which can give a false sense of success. However, this widespread increase makes it difficult to distinguish who is genuinely skilled in investing from those simply benefiting from overall market trends. A good example of this is the dot-com bubble of the late 1990s. During this period, many investors felt like they were making smart choices as tech stocks soared. However, when the bubble burst, it became evident that not all these investments were well thought out. The aftermath highlighted that the rising market had masked many poorly chosen investments. True investment skill is really tested during challenging times, not just when the market is on the upswing. It's essential to remember that maintaining good investment practices and making smart decisions in a downturn are better indicators of expertise than simply profiting from a rising market. You can be your own worst enemy. Your emotions can be your biggest obstacle in investing. Feelings of fear and greed often lead to poor decisions such as selling your investments during a market downturn or buying them during a market peak. These emotional reactions can cloud your judgment and lead to choices that are more about impulse than strategy. Behavioral finance, a field that studies how emotions and psychology influence financial decisions, shows that emotions can significantly impact your investing behavior. For example, the fear of missing out, or FOMO, might push you to buy stocks at high prices, while panic during a market drop can lead you to sell your investments too early. These emotional responses can derail your investment strategy and hurt your long-term returns. To combat this, it's crucial to manage your emotions by sticking to a well-thought-out plan. Regularly reviewing your portfolio and setting up automatic investments can help maintain discipline and keep you focused on your long-term goals. By following a structured approach and avoiding emotional decision-making, you can improve your chances of investing successfully. In summary, these 7 truths, starting early, overcoming hesitation, embracing market uncertainty, understanding strategy limitations, staying calm during downturns, and avoiding overconfidence in rising markets, and finally managing your emotions, are essential for long-term investment success. By recognizing and applying these principles, you can navigate the complexities of investing with greater confidence and resilience. If you liked this video, and if you made it this far, I'm guessing you probably did, then I have some good news for you. I'm giving away my PDF guide to the 10 dividend investing commandments, or the criteria that I use to pick dividend paying stocks, and I'm giving it away to you for free. All you need to do is submit your email in the link below and it'll get delivered to your inbox straight away. Again, that's for free. But that's not the only benefit of joining the email. You also get updates on the almost daily dividend portfolio, interesting stock ideas or news, and special deals and free stuff that I can share with you. Thanks for watching, and I hope to see you on the next video. See you!